In just one trading session, Nvidia lost $170 billion in market value. That's bigger than the entire valuation of Disney, vaporized before lunch. The S&P 500 cracked, oil rocketed past $109 a barrel, and a chip company nobody outside Silicon Valley had heard of suddenly became a $95 billion monster overnight. The last 24 hours on Wall Street just rewrote the rulebook. Strap in, because this is what really happened, and why your portfolio probably already feels it. Start with Nvidia. The world's most watched stock plunged 4.6% intraday on May 15, slicing roughly $170 billion off its market cap in hours. The trigger was a bombshell report. Despite Washington's green light for Nvidia to sell H200 AI chips to as many as 10 Chinese companies, not a single one actually placed an order. Beijing quietly told its tech giants to stand down. The deal of the decade just got ghosted before it even started. And here's the kicker. Nvidia's share of China's AI chip market has collapsed from a peak of 95% to just 8%. 8. Meanwhile, Chinese domestic chips crossed 55% market share for the first time ever in the first quarter of 2026. Translation: China doesn't need Jensen Huang anymore. They're building their own. Every dollar of Nvidia's China revenue that disappears is a dollar that won't show up in next week's earnings report. Investors smelled the blood. Now flip the script. While Nvidia was bleeding, a rival most investors had never heard of just stole the show. Cerebras Systems, an AI chipmaker priced at $185 per share, opened on Nasdaq at $350, peaked at $386, and closed up 68% at $311. The biggest U.S. tech IPO since Uber in 2019. $5.55 billion raised. A $95 billion valuation literally overnight. Cerebras builds the largest computer chips on Earth, slabs of silicon designed to crush AI inference workloads faster than traditional GPUs. Revenue jumped 76% last year to $510 million. They flipped from a $481 million loss to $88 million in profit. But here's the twist. The very next day, the stock fell 10%. Even AI darlings can't escape gravity. The hottest IPO of 2026 hit an air pocket within hours. Microsoft was the rare green pulse in a sea of red. Shares climbed 3.81% on May 15 after billionaire investor Bill Ackman revealed a core position in his newly launched PSUS fund. Ackman's bet? Microsoft's long-term AI and cloud growth is being seriously underestimated by the market. When the most opinionated activist on Wall Street places a multi-hundred-million-dollar wager publicly, retail investors notice. Microsoft cracked higher even as the Nasdaq sold off violently all around it. Defense contractor CACI International surprised everyone, ripping 4.2% higher to $502.63 on a $113.8 million U.S. Navy contract win. With geopolitical tension boiling over, defense names are quietly becoming the smart money hideout. While tech investors panic over chip exports, Pentagon spending keeps grinding higher. CACI's move was small in dollar terms but loud in signal. War stocks are firmly back on the radar in 2026 right now. Now the elephant in the room. Oil. Brent crude rocketed near $109 a barrel, up 3.3% in a single session. U.S. crude jumped 4.2% to $105.42. The week's total gain? Over 10%. The cause was raw. President Trump and Iran's foreign minister exchanged threats, blowing up hopes of a deal to stop ship attacks around the Strait of Hormuz. The shipping lane the entire world depends on. And when oil spikes, history repeats. 10 of the last 12 U.S. recessions were preceded by an oil shock exactly like this one. The market is pricing that memory in real time. The 30-year Treasury yield surged to 5.127%, the highest level since 2007. The 10-year hit 4.595%. Higher yields punish high-growth tech, raise mortgage rates, and make every borrowed dollar more expensive. The bond market is openly screaming danger right now. That bond market panic detonated equities. The S&P 500 shed 1.24% to close at 7,408. The Nasdaq fell 1.54% to 26,225. The Dow lost 537 points, down 1.07%. The Russell 2000 was the worst, crashing 2.44%. Small caps always get hit hardest when borrowing costs spike. That's the historical playbook, repeating itself almost perfectly. AECOM was the day's biggest single stock blow-up. Shares plunged 9.6% after the engineering giant reported flat first-quarter revenue and a brutal $27.4 million negative free cash flow. When a sleepy infrastructure name misses cash flow that badly, the algorithms don't wait around. They dump first and ask questions much later. AECOM's chart looked like a literal cliff. And for investors who thought defensive engineering names were safe in this market, it was a painful wake-up call. Semiconductors got absolutely hammered together. Intel slid more than 6%. AMD lost 5.7%. Micron Technology dropped 3.4% to $749.33 as investors locked in gains. Even Cerebras itself fell 10% on day 2. The entire AI chip complex showed real cracks. When the leader of a sector misses by even a hair, the rest of the group bleeds out together. May 15th was the moment chip enthusiasm finally collided with geopolitical reality. Crypto wasn't immune either. Gemini Space Station, the publicly traded entity tied to the Winklevoss twins' empire, surged 11.6% after Winklevoss Capital Fund poured in another $100 million. Bitcoin meanwhile slid back near $82,000 as risk-off mood gripped traders worldwide. The story of the day was rotation. Money fled the highest multiple AI names and squeezed into select crypto, defense, and software plays. The herd was sprinting somewhere completely new and fast. Behind all of this sat one explosive headline. The summit between President Trump and Chinese President Xi Jinping ended with 0 major policy breakthroughs. Markets had been pricing in a fresh trade deal, eased export controls, maybe even broader chip access. Instead, traders got a handshake and a generic press release. The disappointment was instant and unforgiving. Tech names that had rallied for weeks on optimism gave it all back in hours. When summits fail, futures don't wait politely for a Monday open. Now layer on inflation fear on top. Rising oil plus rising yields plus a suddenly hawkish Fed equals one truly nasty cocktail. CNBC analysts are openly warning that markets may be sleepwalking straight into a recession. Morgan Stanley flagged the Iran war oil shock as the single biggest swing factor for U.S. equities this quarter. And the most dangerous part? Most retail investors haven't repositioned at all. They're still holding the exact same AI tech basket from January. When music stops, shares disappear fast. So who's actually winning right now? Defense contractors writing huge government spending. Energy producers loving expensive crude. Cash-rich value names that don't need any cheap debt. Cybersecurity firms quietly benefiting from elevated geopolitical risk. And Bill Ackman's Microsoft bet, if AI cloud demand keeps grinding higher. Who's losing? Anything reliant on cheap money, anything heavily exposed to China revenue, anything with a price-to-earnings ratio that needs perfect macro conditions. The sector rotation under the surface is already brutal. And don't ignore the calendar. Nvidia reports earnings next week. The street wants reassurance that the H200 China problem is fixable, and quickly. If guidance disappoints even slightly, you'll see another fast leg lower in the entire AI complex within minutes. If management threads the needle perfectly, the stock could rip back 20% overnight. Earnings season has officially turned into a coin flip on the world's single most important company. There is no comfortable middle ground left for shareholders to sit in anymore. Here's what veteran traders are watching extremely closely tonight. The 10-year Treasury yield sitting at 4.59%. The dollar strengthening hard against everything except gold. Volatility creeping back up after months of artificial calm. Insiders selling in megacap tech quietly accelerating. And short interest in semiconductors climbing for the first time in 12 straight months. Each of these alone is a flashing yellow light. Stack them all together and you get one giant signal. Easy gains are over. What does all of this mean for your portfolio? It means concentration is now your biggest enemy. The narrow leadership of just 7 AI megacaps that drove the entire market in 2025 is finally fracturing. Market breadth is collapsing fast. Cash is suddenly attractive at 5% yields. And the sectors most ignored over the last year, energy, defense, healthcare value, are quietly rotating into leadership. The next 12 months may not reward what worked in the last 12 months. Adapt or get punished. Zoom out for 1 second. In a single trading session, we saw Nvidia lose more market value than the GDP of most countries, a $95 billion AI chipmaker debut and then slump, oil shock back into the headlines, treasury yields hit decade highs, and a Trump-Xi summit deliver absolutely nothing concrete. This was not normal volatility. This was the day the regime quietly changed. Whether you trade daily or hold for retirement, the rules from 2023 are being rewritten right in front of you. So here's the question I want you to answer in the comments below. If the AI trade is finally cracking for real, where exactly is the smart money going next? Defense and energy? Crypto majors? Or cash sitting on the sidelines waiting patiently for a true correction? Or do you actually think this is just a healthy shakeout before Nvidia earnings reignites the bull run? Pick a side and give me your strongest reason. The boldest call gets pinned. See you in the discussion. That's the story. If you'd watch one more like this, hit subscribe and I'll have another ready soon.